Stop what you're doing. Seriously, if you own Alpha Metallurgical Resources, or honestly any coal stock for that matter, you need to hear this. Last week, I ran AMR's Q1 2026 earnings through 5 deep fundamental valuation models, plus Warren Buffett's and Peter Lynch's legendary checklists, and what I found literally shocked me. By the end of this explainer, you'll know exactly if this stock is a heavily discounted Buffett buy or just a classic Lynch value trap. Because valuing this company right now, it's like trying to catch a falling knife in a hurricane. Let's start right out of the gate with a brutal contrarian reality check. AMR just reported a preliminary net loss of $11 million for the quarter. Ouch, right? That's an 86-cent loss per diluted share. Now, for a leading U.S. supplier of metallurgical coal, a negative bottom line like that usually triggers a massive panic sell-off. It forces us to ask a really bold rhetorical question. Is the fundamental thesis for this stock completely broken, or are we just looking at a temporary blip? But here is the wild contradiction that is absolutely driving retail investors crazy right now. We all hate seeing red on the bottom line, but despite that $11 million net loss, their adjusted EBITDA actually jumped to a positive $30 million. No way, right? How on earth do you reconcile bleeding $11 million on paper with $30 million in positive adjusted earnings? Well, today I'm going to give you a clear, actionable framework you can steal to make sense of this exact situation. We really need to dig into the models and the macro environment to see what's actually going on under the hood.
So here's our roadmap for this earnings autopsy. First, we'll look at the Q1 financial snapshot. Then we'll cover the massive cost and freight headwinds hitting the industry. Third, we'll look at some really weird coal market index divergences. Fourth, we'll analyze management's strategic moves. And finally, we'll look ahead to the rest of 2026. All right, let's jump right into Section 1, the Q1 2026 financial snapshot.
You know, despite that net loss we talked about, AMR was actually incredibly active on the ground. They sold a whopping 3.6 million tons of coal, and that generated over $447 million in non-GAAP coal revenues alone. Total GAAP revenues are actually north of $523 million. So the top-line volume, it is absolutely there. People are buying the coal. But here's where things get a bit sticky. This really brilliantly illustrates the margin squeeze they're facing. Non-GAAP realization per ton, so what they actually get paid, jumped from roughly $115 in Q4 to over $124 in Q1. And hey, that's great. But look at the cost side. The cost of coal sales rose right alongside it, jumping from around $101 up to almost $108 a ton. So they are making more money on the product, but the sheer expense to get it out of the ground is just eating away at those hard-earned gains.
Which brings us perfectly to Section 2, cost and freight headwinds. What exactly is making it so expensive right now?
Well, if you think filling up your own car hurts right now, imagine having to buy 23 million gallons of diesel. CFO J. Todd Munsey pointed out that even slight inflation at the pump deals a multi-million-dollar blow to their bottom line. Just a moderate price hike literally adds a couple of dollars to the cost of every single ton they produce. It adds up incredibly fast. And beyond fuel, there's a staggering supply glut out there. The global market is currently absorbing roughly 11 million tons of new longwall high-vol coal. Meanwhile, production cuts elsewhere have only amounted to about 1 to 2 million tons. That is a massive imbalance, and it's acting like a wet blanket, directly pressuring their selling prices. Now, to understand how they are navigating this hostile environment, you really need to understand the term FOB, or Free On Board Vessel. In simple terms, it means AMR pays to deliver the coal to the port, but the second it's loaded onto the ship, the buyer takes over all the freight costs and transport risks. And let me tell you, that distinction is an absolute lifeline right now. Global shipping rates have spiked around 40% recently, heavily driven by geopolitical conflicts. By strategically relying on those FOB contracts, AMR is successfully protecting their margins and passing all that crazy volatile freight risk directly to the buyers, particularly for their South Asia transactions. Okay, moving on to Section 3, Coal Market Index Divergences. This is where things get historically weird. First off, let's define PLV, or Premium Low Vol Coal. This is basically the gold standard for steelmaking coal, and its pricing is heavily linked to Australian exports. Right now, PLV's pricing behavior has completely detached from the rest of the market. It's living in its own world. Just look at this massive stair-step drop. You've got a nearly $42 pricing gap down from Aussie PLV to US East Coast low vol. And then from there, it's another massive plummet down to US high vol A. The spread between US high vol and low vol has exploded from historically just $5 to nearly $38 a ton. This is driven by Australian supply tightness on the high end and that massive US supply glut we mentioned earlier on the low end. Management is acutely aware of this. CEO Andy Idison specifically noted that these massive pricing gaps are historically unusual. And here's the rub. If you're sitting on a ton of high-vol coal, which currently makes up a huge chunk of AMR's shipments, you are effectively stranded at the very bottom of that pricing staircase. So what do you do about it? Let's check out Section 4, Strategic Moves and Mitigations. Their major pivot right now is rushing the Kingston Wildcat mine online. In fact, they confirmed development is concluding in Q2, with production ramping up through the rest of the year. This is a potential game changer because Wildcat is a low-vol mine. It's going to inject that highly profitable premium coal into their portfolio just as the market is screaming for it. It's their ladder to climb up that pricing staircase. Operationally, they also pulled off a massive logistics win recently. They were steering down a planned 4-week equipment outage at their primary export facility, Dominion Terminal Associates. That could have been disastrous, but the sales team proactively kept the coal moving by finding alternative capacity. It's a huge testament to management's agility, and honestly, that's exactly the kind of smart operating Peter Lynch looks for when he's evaluating a leadership team. Finally, let's hit Section 5, looking ahead to 2026. Where do we go from here? They are actually in a pretty stable position to weather the storm right now. 48% of their metallurgical tonnage is already priced and committed for the year at an average of $132.03 per ton. Another 43% is committed but unpriced, so they have a really solid revenue floor built in, while still retaining the upside optionality if prices recover. As for their spend, management is holding firm on their cost guidance, expecting to finish the year between $95 and $101 per ton. But, and this is a big but, they've clearly warned us that if geopolitical tensions and general inflation keep lingering around, those cost numbers will almost certainly have to be adjusted upward later this year. Which leaves us with one incredibly critical thought to end on. Alpha Metallurgical Resources knows exactly where the market is weak, and they are rushing to adapt. But will pivoting to premium low-vol coal through the Wildcat mine actually be enough to outrun global diesel inflation and freight spikes? Is this temporary distress making it a classic Buffett buy, or is this a structural decline proving it's a Lynch value trap? That is the billion-dollar question we'll be modeling out in the quarters to come. Thanks for hanging out with me for this explainer. I'll see you on the next one.